Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that bid up prices on questionable Federal Reserve decisions. Yes, today's topic is Powell's big mistake, and it is a doozy. Let's get out of the disclosures out of the way. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recommendations or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity and business press video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. All right, so let's get the FOMC announcement out of the way. The Fed did cut interest rates by 0.25% to a blended rate of 1.75 to 2, which comes out to 1.88 if you want to do the math. And that was about it. The Fed kind of said, look, we think economic growth is going to be fine. And then on the other hand, he said, well, we can't really predict that. He said, I know, it's just a weird meeting. I mean, not only was the committee divided, I mean, some of them didn't want to cut, some of them wanted to hike, some of them wanted to cut even deeper. We saw a very divided committee, and yet we got the cut that Wall Street asked for. And then the Fed not only said, we're not really sure, where the economy is going, even though we're going to say that it's going to grow. We also don't think we'll be cutting rates any further this year, and we'll be raising them next year. Yeah, right. Not going to happen at all. The Fed made a big mistake because he blamed the economic growth on the tariffs, and that isn't the cause. It is actually the Fed's monetary tightening, and we've shown this in World Dollar Liquidity. We'll look at it again today just for the fun of it. Now, before we dive into that, and what the implications of the rate cut look like and why this is not a bullish narrative to stock. Even though investors did come in, the market sold down, well, whatever. And then went right back up because investors have this view that rate cuts are bullish. They are at the bottom of markets or in the early stages of a bull market. But due to the monetary lags, they're not. Now, when Fed Chair Powell was asked about the repo operations over the last 2 nights, he quickly dismissed them as a need for cash due to the estimated tax payments, to which was immediately countered by the press, good for them, by saying, wasn't this date known like a year ago? So why would this be a problem? It wasn't a surprise. All the banks should have known there was a demand for cash on that day because they know that business owners tend to wait till the last possible day to send the check. So why wouldn't we? To which he had really no answer other than, well, there was a need for liquidity and essentially we provided it, and that's the role of the Fed to do. So what actually happened Monday night and Tuesday night is every night at market close, the banks then have to meet their reserve requirements. So they have to have so much cash on hand. If they don't, they go to another bank that has a surplus of cash and they borrow it and they pay that other bank an overnight rate equivalent to the federal funds rate. Well, what happens when the demand for cash either exceeds what the banking system can provide, or what if the banking system doesn't have the cash or doesn't want to provide the cash? Well, in that case, the Fed steps in as the lender of last resort, which is what they did both Monday to the tune of, what did they do, $53 billion, and then last night they had a demand for $80 billion, but had a cap setting at $75 billion, and these were one-night loans, so they were not, anyone in the news saying, oh, this is a quantitative easing. It's not. It's done. The loan from last night will be done by tomorrow. It's all overnight loans. So that'll be early in soon, unless the Fed does another repo operation. So what it means is their demand for dollars exceeded what the banking system could supply. And what makes this really interesting is and the Treasury has not started this big borrowing binge, but now that number is up to $600 billion going into the rest of the year, is if we have a demand for cash on a known day the tax payments are due, what's going to happen when the Treasury needs to go out and borrow the $600 billion? And what investors were looking for today was hearing the Fed say we were going to monetize that debt, and they did not say that. So it tells us as I've said, the plumbing in the markets are clogged. There's a global demand for dollars. Now, it doesn't mean this demand for dollars was within the U.S. There are only 24 banks that can come and bid on these overnight repos when they need them. But who they lend that out to could be anybody. Could be a foreign bank, could be a foreign company, could be anybody who needs dollars. But that's what happened last night. There was a demand for dollars. It was unexpected. And at the moment, there doesn't appear to be a demand tonight for this. But this just adds to the narrative. There's a problem in the plumbing. Now let's go over to the charts, and they still have not updated the software to fix the browser issue. So we can see that liquidity has gotten back over into positive territory above zero. When we look at the NASDAQ McClellan Summation Index, it's really not an overly strong move considering that we had 2 liquidity events in the last 48 hours. But as far as the problem and why there will be more rate cuts this year, even though the FOMC did not feel that there would be, is world dollar liquidity. And what you can see here is I've updated this chart and I put the average in, which is 24%, meaning the number of dollars on a year-over-year basis needs to grow globally by 24%, and it's currently contracting. This is why we're in a global slowdown. We're not because of the tariffs, not because of the tax cut, all those mitigating factors. Yes. Are they the cause? No. If the trade war ended tomorrow and the tax cut was repealed, we would still see this slowdown because it takes time to get dollars out in the economy, and those two mechanisms can't create enough fast enough. Only the Fed can. So you can see when it gets down here under this, say, 20 to 24% range, recessions tend to follow because there's not enough liquidity. And look, you can see since 2016, the world has been starved for dollars and it continues to be begging for dollars. So last 2 nights, repo operations, while they're being dismissed as a tax payment deadline, the reality is it could be something more. We just don't know. Now, as far as the bullish narrative goes on stocks, and people say, well, don't fight the Fed when the Fed is easing cut or buy stocks. Well, the Fed cut rates at the top of every market, every one of them. So there's an 18-month lag, so we can go down here, and we can look from September where we are to April. You can see count is 18. So this is where we are right now. The economy is feeling a $30 billion balance sheet unwind plus a federal funds rate at 1.63%. So the economy is feeling as if interest rates are at 2.13%. So what's going to happen between May and June? You're going to see a total tightening of $90 billion plus a rate hike coming deferred in June, which would actually be December, right? Let's see. November. And this block right here is about two rate hikes, because each hike is equivalent to roughly $60 billion. And then the next 3 months, you see $120 billion, and you see a hike. What you see here is 2.5 hikes. This is what investors really don't understand, is the monetary lag. So everyone that says, oh, the Fed's cutting buy stocks, look, go back to any market peak and you'll find the Fed cutting at the top, because it doesn't work that way. See, what happens here is when the Fed cuts, it starts its own 18-month track from now. So I've already updated, so you see it's at 1.88. So this will not be felt by the economy for 18 months. But in the meantime, starting tomorrow, the Fed is going to buy bonds to push, or bills, probably treasury bills, to push the federal funds rate lower. That's what sends interest rates down, is not the economy at this point. It's the Fed plus the economy. So what will happen now is we should expect to see the economic data continue to deteriorate. And what investors are going to view this as is very simple. It's not working. No, it works. It just will work 18 months from now. But because this is such a small hike, it's not going to have a big effect. And the dollar rallied today, so it kind of took that rate hike and blew it out the door. So the S&P 500 reversed all of its losses, managed a very slight gain, sitting just over 3,000 points. Pretty impressive. The market reversed that pretty hard. Volatility broke support, and it's tried to break over resistance today and was unable to. Found sellers because, again, the market wants to sell volatility, so it's so cheap that everyone will buy it and drive it higher. But nevertheless, it's got coming back down here to this support level right here. We'll see if that holds. Tomorrow, you got to look. Sometimes the market will wait a day to react or two. Let's take a look at 10-year Treasury yields. Bounced off resistance, hanging right around their 50-day moving average. The 30-year bounced off its support but didn't trade very much. So you can see it was just pretty thinly traded in terms of the range. But let's go look at the TLT. And this is kind of, so what's going to hold you from rebalancing the portfolios at the point? Because that's really the question is, when you see a move down like this, it's normal to see it come up and check in with resistance. Well, we don't know if the market is going to try to short bonds down to here, where there's a lot more resistance. I'll show you in a moment. Or if it's going to bound around this range here, and this will become support. We don't know. Now, we know this is trying to be support because when we go back on the charts, we see support here and all through here. So at the moment, this looks like a pretty good area of support. However, there's more support down here. So we could possibly see market participants drive yields higher and bring this down here. I think it's going to be difficult. But in the early stages of a hiking cycle, you just kind of got to be a little careful. So we'll probably, maybe wait into early next week, let the market digest this, see what happens here. Because we don't want to take a move down here only to have it bounce back. We'd like to catch it at the right opportunity. So we'll see. But to give you an idea, looking at ag commodities, the reverse of this is you start to form a bottom, you go cross resistance, and then you reconfirm it. So see how today it came back down, confirmed, and now resistance is becoming support. If this holds, then what happens is it should make a next move higher, and that will probably be up in here somewhere. I mean, realistically, this may be better positioned to up here. So next move, we should see it kind of crawl up to here and then reconfirm. And then the next move is the big move. So when usually markets move in waves. So if it got up to here, the next move probably is much higher. And then you get a fourth or fifth move. And usually that's kind of about where the goose gets cooked. So that's kind of where things are at in the market with that stuff. Let's take a look at crude oil. Came out of this symmetrical triangle. Looked like a bullish move. Came back down into it. Again, there's too big of a glut of oil to really drive a demand. I mean, demand have to shoot through the roof, and it's just unlikely. And even if it did, there's so much supply and so much production that can be turned on. And we see oil and gas producing stocks look like they broke out of this supply zone, broke through resistance, and then rejected. And they're trying to hold this, but I have a hunch that they're probably not. And that should bring sellers back into the market and drive this down. Not a good thing for the markets because there's a lot of jobs tied to the oil and gas industry. So let's see what else we've got that's worth taking a look at. Gold miners reversing. It's easy to see it when we look at the junior miners. You can see it's really starting to look like a topping pattern where prices just can't sustain through the supply zone, which tells us that prices should come down to here and then somewhere down in here where we would really want to take a position because we know the smart money is sitting down here. But before that happens, I expect the bond market to make its big move. And with what's coming toward the end of the year with all this treasury issuance and the Fed looking like they're not going to monetize it, well, let's just put it this way. We already know that we had an illiquidity event the last 2 days and the Fed marginally stopped it. What are they going to do when $600 billion comes rolling through? It's going to be interesting. I'm Steve Van Metre. We'll see you Friday, and thanks for watching. Bye now.